Welcome to the Deep Dive, the show that digs through the data to pull out the key insights just for you.
Glad to be here.
Today, we're taking a plunge into Newmont Corporation, ticker's NEM, on the New York Stock Exchange.
The big one, the undisputed giant in gold production.
Exactly. But here's the real question we're tackling. Newmont's got this incredible scale, right? But can they actually turn that size into better value for shareholders, especially now with costs heading upward?
Yeah, or is it, maybe getting too big, too complex to run profitably? That's the tension.
That's precisely it. It's a critical question, particularly if you're invested in or thinking about the precious metals sector.
Definitely. It's a company with a long history, sure, but also one that's made some huge, very recent moves, big strategic shifts that are still, well, shaken out.
Absolutely. And hey, before we really get into the weeds, just a quick reminder to like and subscribe to the One Trillion's YouTube channel.
Yeah, we're always covering mining companies, big and small. And we do actually take requests for stocks from members right there in the comments.
We really do. Your engagement helps us focus these deep dives on what you want to hear about.
So our goal today, and this is all current, as of August 9th, 2025, when NEM closed at 68.98 cents, is to really break down Newmont. We'll look at the business, the management, financials, risks, the whole picture.
Trying to pull out the most important stuff, give you that comprehensive view without drowning you in detail.
Exactly.
Are you?
Ready to jump in?
Let's do it. So the operations. What makes Newmont this gold behemoth? And crucially, are there signs that size might be becoming a bit of a burden?
Okay, this brings us straight into Chapter 1, business analysis. The world's gold behemoth at a crossroads.
Right.
So fundamentally, Newmont is what we call a vertically integrated gold and copper miner.
Meaning they handle pretty much everything.
Yeah, the whole life cycle. From looking for new deposits, actually building the mines, getting the ore out, processing it, all the way to refining it into those doré bars they sell.
That control over the whole process must be a big deal, and revenue-wise, it's mostly gold.
It is. Gold brings in about 84% of the revenue. But, and this is increasingly important, they've got a strategic focus on co-products. Things like copper, silver, lead, zinc.
Copper especially seems key to their future plans, right?
Very much so.
Huh.
In 2024, just to give you some numbers, they produced an impressive 6.8 million attributable ounces of gold.
Wow.
And on top of that, 1.9 million gold equivalent ounces GEOs from those other metals. That included 153,000 tons of copper.
Okay, so GEOs. That's just a way to bundle the value of all the metals into one gold number.
Exactly. Gives you a single metric for total output value. Makes comparisons a bit easier.
Makes sense. And where are they actually doing all this mining?
Their operations are really focused on what the industry calls top-tier jurisdictions. Think North America, South America, Australia, Africa.
Stable places, generally.
Right. They have this Tier 1 portfolio strategy. The idea is to focus on assets that are large-scale, have a long life, and theoretically lower costs, all in these politically stable regions.
So places like Boddington and Tanami down in Australia.
Yep, and Peñasquito in Mexico, they're big joint venture Nevada gold mines in the U.S. It's not just random geography, it's a deliberate strategy to minimize political and regulatory risk.
Okay, but that brings up a critical point you mentioned earlier, costs. How are they doing on that front, specifically the all-in sustaining cost, the AISC?
Ah, yes, the AISC. This is where the story gets, well, challenging for Newmont. There's a really stark trend here.
Okay.
Back in 2019, their AISC was $966 an ounce. Pretty good.
Yeah.
By 2024, it had climbed to $1,516. And their guidance for this year, 2025, is $5,630 an ounce.
Whoa, hold on. That's, what, nearly a 70% jump since 2019?
About 69%, yeah. It's a huge increase. And the key takeaway here is that for Newmont, sheer size hasn't automatically meant lower costs.
So being the biggest doesn't mean they're the most efficient.
Not necessarily. It means cost control becomes incredibly important for them, arguably even more critical than just benefiting from a higher gold price. That cost inflation has been seriously eating into their potential margins.
Yeah. That really challenges the assumption that bigger is always better in mining margins. But is there anything working in their favor operationally? What about the quality of the rock they're mining? The ore grade?
That's actually a definite strength. You know the saying, grade is king in mining? Well, Newmont's maintained a really solid ore grade, ending 2024 around 0.96 grams per ton. That kind of stability is a huge plus when you're constantly fighting against declining grades in older mines.
Okay, so the quality is good. And I saw something about their reserve life.
Oh yeah, that's remarkable. They have a 22.7-year reserve life index. We're talking 134.1 million ounces of gold reserves against their 2025 production guidance of 5.9 million ounces.
22 years. That's incredible visibility.
It's unparalleled, really. It lets them plan for the long term, make strategic investments without that constant pressure of finding the next deposit right now.
That makes a huge difference. Okay, let's zoom out a bit. What's the broader market like for them right now?
Well, the timing is, frankly, very good. They're operating in a highly favorable commodity price environment. As of early August 2025, gold's near $3,386 an ounce, a historic high.
Wow.
Silver's strong too, $38.35. Copper's at $4.46 a pound. And there's some powerful long-term trends supporting these prices.
Like what?
For gold, you've got ongoing macroeconomic uncertainty, inflation worries, pretty strong central bank buying. For copper and silver, it's all about the energy transition.
Right. EVs, solar panels, grid upgrades.
Exactly. All that creates huge demand and, frankly, structural supply deficits. So these are some serious tailwinds helping Newmont's top line.
Okay, strong backdrop. How does Newmont actually stack up against its main rivals then, like Barrick, Agnico Eagle?
Good question. In terms of sheer size, market cap-wise, Newmont is dominant. Around $75.8 billion, it dwarfs most competitors.
But size isn't everything, as we discussed with costs.
Precisely. Their guided 2025 AISC of $1,630 is definitely higher than, say, Agnico Eagle's, which is guiding to $1,250, $1,300. It's also the upper end of Barrick's range.
So not the cheapest. How does the market value them then, considering that?
If you look at a metric like enterprise value per ounce of reserves, EVOS, it gets interesting. Newmont's around $573 per ounce.
Okay.
That's way higher than Barrick at $334 or Goldfields at $350. But it's less than half of Agnico Eagle's $1,288.
So the market gives them credit for something, but not as much as Agnico.
I think that's right. It suggests the market puts a premium on Newmont's assets, likely because of their long life and location in stable places, but it's holding back a bit compared to Agnico, probably because of that higher cost structure.
So their competitive advantage, their moat, it's not about being the low-cost leader.
Definitely not. Based on AIC, they don't have a durable cost advantage compared to the best operators. Their edge comes from other places.
Okay, so where's that edge then, if not costs?
I'd say it boils down to three things. First, as we mentioned, that unmatched reserve base and longevity. The 22-year runway is massive. It allows for disciplined, long-term thinking, which is rare.
Right, avoids that short-term scramble. What's second?
Second is that portfolio of Tier 1 assets in stable jurisdictions. Deliberately focusing on places like the U.S., Canada, Australia, it significantly reduces political and regulatory headaches compared to operating in riskier parts of the world. It's a powerful de-risking factor.
Even if it means slightly higher operating costs sometimes.
Potentially, yes. And third, it's their direct exposure to commodity prices.
The no hedging policy.
Exactly. It's a very deliberate strategic choice. They don't hedge their gold and copper sales. Now, hedging smooths out revenue, sure, but it also limits your upside if prices surge.
Which they have been.
Right. So by staying unhedged, Newmont offers investors pure direct exposure. If you're bullish on long-term metal prices, NEM becomes a sort of go-to vehicle for that large-scale exposure.
Got it. Okay, that gives us a really clear picture of the business itself, the scale, the cost, the real advantages. Let's pivot now to the people making the decisions. Who's steering this ship?
All right, that takes us to Chapter 2, Management Evaluation. Leading the team is CEO Thomas R. Palmer, and he's got a pretty seasoned executive group around him.
And their tenure has been marked by some really big moves, hasn't it?
Absolutely. Bold consolidation has been the name of the game. It started with the $10 billion Goldcorp acquisition back in 2019.
Which was huge at the time.
And then they topped it with the even larger Newcrest Mining acquisition in 2023. These weren't just tweaks, they were transformative deals. They cemented Newmont as the world's #1 gold producer and significantly boosted their copper footprint.
So the Newcrest deal especially, that feels like the defining move for this management team.
I'd agree. It's the big strategic gamble. It brought in some fantastic world-class assets, no doubt, but it also brought significant integration challenges, complexity, and some assets that aren't exactly low cost.
So how are they handling that integration?
Their response has been pretty swift and decisive. They launched this portfolio optimization program. The goal is to sell off over $3 billion worth of assets they consider non-core.
Streamlining things after the big merger.
Exactly. Ultimately, the success of the Newcrest deal, and really the legacy of Palmer and his team, hinges on executing these divestments, actually delivering the promised synergies or cost savings, and proving that this bigger, reshaped Newmont is truly better and more valuable.
A lot riding on execution then. How does this feed into their overall approach to spending money, their capital allocation?
They lay out three main priorities. First, keep the balance sheet strong. Second, reinvest in the business, focusing on those Tier 1 assets. And third, return excess cash to shareholders.
And that reinvestment, they're aiming for a steady production level.
Yeah, the goal is to maintain a stable profile of around 6 million ounces of gold and about 150,000 tons of copper each year for the next decade or so, relying on that Tier 1 portfolio.
And shareholder returns, have they been delivering?
Pretty significantly, yes. In 2024, they returned $2.3 billion to investors. That was $1.1 billion in dividends and $1.2 billion through share buybacks.
And they're keeping that up.
It seems so. In the second quarter of 2025, the board approved another $3.0 billion share repurchase program. That's a pretty strong signal of confidence from the board. The quarterly dividend is currently running at $1.25 per share, which seems sustainable for now.
Okay, so the board's signaling confidence with buybacks. But you mentioned a tension there earlier.
Yeah, the interesting one. How does this multi-billion-dollar buyback program, which implies the board thinks the stock is cheap, square with the pattern of insider selling we'll get to later?
Yeah.
It's something investors need to weigh.
Definitely something to keep in mind. This whole discussion about spending and returns naturally leads to return on invested capital, or ROIC. How's that looking? It tells you how well they're actually using all that capital right now.
Exactly. And Newmont's ROIC has been, well, volatile. It had a good run in 2020, 2021 when gold prices were taking off. Then it dipped in 2022, 2023. That was partly inflation hitting costs, but also the huge chunk of capital spent on acquiring Newcrest.
Makes sense.
But it has bounced back quite strongly in 2024 and in 2025, helped by record gold prices and the initial benefits starting to flow from the Newcrest integration. The key now is whether they can sustain that improvement. That'll be the real test of whether these big strategic bets are paying off in long-term value creation.
Sustained ROIC improvement, a key indicator to watch. Okay, let's dive into the numbers themselves.
Right, so let's move to Chapter 3, Financial Analysis. As we said, market cap around $75.8 billion as of early August 25. Easily the most valuable gold miner out there.
And looking back at their financials over the last 5 years, what jumps out?
You see that massive step up in revenue in 2024, obviously reflecting the Newcrest acquisition. Scale has definitely increased. But translating that scale into consistent profit and, importantly, free cash flow, that's been more challenging.
Oh, so?
Well, net income has been really volatile. They actually reported net losses in both 2022 and 2023, despite relatively strong gold prices.
Losses, even with gold doing well.
Yeah, driven by impairments, integration costs, and those rising operating costs we discussed.
Yeah.
It highlights the pressure they've been under.
And that volatility shows up in free cash flow, too, I imagine. That's a metric a lot of investors focus on.
Absolutely. And Newmont's SCF has been particularly lumpy is a good word for it. They generated a really healthy $3.6 billion back in 2020.
Strong year.
But then, as costs started biting, FCF really dwindled. It hit a low point of just $88 million for the full year 2023.
$88 million. On their scale, that's practically zero.
It was very close to zero. And that was a major red flag. It showed that rising costs, both operating and capital, were basically eating up almost all the cash generated from operations, even with gold prices holding up reasonably well then.
A real warning sign.
It was. But then, the rebound was just as dramatic. FCF recovered to $2.9 billion in 2024, and then they posted a record $1.7 billion in just the second quarter of 2025.
Okay, so what does that wild swing tell us?
It reveals a business with immense operating leverage. That near-zero FCF in 2023 shows the risk how vulnerable their high-cost structure can be. But that massive rebound shows the flip side. Enormous cash generation potential when metal prices are high and they execute well.
Like a coiled spring, you said earlier.
Exactly. Huge potential upside, but also significant downside risk if things go wrong. This FCF volatility is really at the heart of the whole bull versus bear debate around Newmont stock.
Despite that earnings and cash flow roller coaster, how's the balance sheet holding up?
Actually quite strong. They maintain an investment-grade credit rating, which is important. Their debt-to-equity ratio is pretty healthy at 0.26x.
Okay.
And their current ratio, which measures short-term liquidity, is a solid 1.98. Plus, they've been actively paying down debt since the Newcrest deal, retiring about $1.4 billion in 2025 so far. So the balance sheet looks flexible.
Good to know. All right, let's talk valuation. Is the stock cheap, expensive, somewhere in between?
On most comparisons, Newmont isn't the cheapest option in the gold sector, We touched on that EV per ounce of reserves metric earlier.
Right, the $573 per ounce number.
Yeah. Higher than Barrick and Goldfields, but well below Agnico Eagle. It
Yeah.
suggests the market values the asset quality and stability, but maybe penalizes them slightly for the higher costs compared to the absolute cost leaders.
Okay, that's relative valuation. What about trying to figure out an intrinsic value? Like with a discounted cash flow or DCF model, I know these rely on assumptions.
They absolutely do, and it's crucial to remember these are educational assumptions. But let's run through a plausible scenario. We might assume, say, a long-term gold price of $2,500 an ounce.
Okay, lower than today, but still historically high.
Right. Assume production stays around 5.9 million ounces a year. AISC averages $1,600 an ounce. Use a discount rate, or WACC, of 8.5%, and a long-term growth rate of 2%.
Standard inputs for this kind of model.
Pretty standard.
Yeah.
Based on those inputs, our educational DCF model points to an estimated intrinsic value somewhere in the range of $75 to $90 per share.
Okay, so compared to the current price around $69, that suggests some potential upside.
It does, within this model's assumptions. But the key thing with any DCF for a miner is sensitivity, especially to the gold price.
How sensitive?
Very. Just a $100 change in that long-term gold price assumption can swing the estimated intrinsic value by roughly 10% to 15%. It really underscores how leveraged these stocks are to the underlying commodity.
Understood. Okay, we've covered the business, management, financials. Let's shift gears and look at how the market actually perceives Newmont right now.
Sounds good. Let's get into Chapter 4, Market Sentiment. What's the vibe on Wall Street?
Yeah, what are the analysts saying?
The general consensus among the 15 to 26 analysts covering the stock is typically a moderate buy or buy.
Okay, generally positive. What about price targets?
The average 12-month price target hovers around $72 per share. So from the current price near $69, that suggests, modest upside. Not huge, but positive.
But is there agreement on that?
Not really. There's actually a wide range in those targets.
Yeah.
Some analysts are down around $60.90, while others are up at $86.
That's a big spread. What does that tell you?
It clearly reflects uncertainty. Analysts seem divided on how well Newmont can manage those costs, integrate Newcrest smoothly, and really capitalize on the high gold price environment.
And the news flow, the media coverage, does that reflect the same mix?
Very much so.
Yeah.
You see positive stories focusing on things like that record-free cash flow they just reported, the asset sales progressing, signs the strategy is working. But then you also see commentary highlighting the risks, the sheer challenge of integrating Newcrest, those persistent cost pressures, and sometimes they've had operational hiccups that led analysts to trim earnings estimates. So yeah, quite a mixed bag in the headlines too.
Okay. What about other market indicators, like short interest? Are lots of people betting against the stock?
Actually, no. Short interest is relatively low. It's sitting at about 1.73% of the public float.
And how does that compare?
It's well below the average for their peer group, which is closer to 3.94%.
So what does that suggest?
It suggests that while the market sees the challenges, there isn't a major conviction trade betting on a significant price collapse. The risks seem viewed as manageable, or at least priced in to some extent, rather than forming the basis for a big short thesis.
Interesting. And technically, how does the stock chart look? Price trends?
Technically, it looks quite strong right now. As of early August 2025, the stock price around $68.98 is trading comfortably above both its 50-day moving average, which is near $59,
Okay.
and its 200-day moving average, which is down around $49.
So it's above both the medium-term and longer-term trend lines.
Exactly. Trading above those key moving averages is generally seen as a confirmation that the stock is in an established uptrend. It's a technically bullish signal.
All right. Positive technicals, low short interest, but analyst uncertainty. A mixed picture on sentiment. Now, who actually owns this stock? Does the ownership structure tell us anything?
It can, yeah. Let's look at Chapter 5, Ownership Structure. Unsurprisingly, given its size, Newmont is heavily owned by large institutional investors.
Big funds, pension plans.
Exactly. They hold 77% of the shares. The biggest holders are the usual suspects: Vanguard with around 12.3%, BlackRock with 10.7%, State Street with about 4.6%.
So mostly passive index funds and large active managers. What's the implication of that?
Well, it provides a pretty stable shareholder base, which is good. But it also means the stock price can be significantly influenced by broader market trends and fund flows that might not have anything to do with Newmont's specific performance. If money flows out of large cap funds or commodity-focused funds, NEM will feel it.
Right. Now, what about insiders? Management, the board, do they own much stock?
This is where it gets, I think, really interesting and maybe a little concerning for some investors. Insider ownership is exceptionally low.
How low?
Executives and directors together own just 0.101% of the company's shares.
Wow, that's tiny for a company this size. A tenth of 1%.
It is. For investors who really value that skin in the game, that alignment between management and shareholders, this is a definite red flag.
Now, are they buying or selling the stock they do own?
That's the other part of the story. Recent transaction data shows a pretty consistent pattern of selling by multiple senior executives throughout 2024 and into 2025.
Okay, so let me get this straight. We just talked about the board authorizing billions in share buybacks, signaling they think the stock is undervalued.
Right, a strong corporate signal.
But the executives actually running the day-to-day business are consistently selling their own personal shares.
That's the apparent contradiction. It creates this significant misalignment, or at least the appearance of one.
How should an investor think about that?
It's tricky. You have to weigh the very strong signal of the corporate buyback against the cautionary signal from the insider sales. Personally, I tend to give more weight to the corporate action. The buybacks involve huge sums and board approval. But you absolutely cannot ignore a consistent pattern of selling by the people who should know the business best. It warrants caution.
A definite point of tension there. Okay, let's try to pull all these threads, the business, the management, financials, sentiment, ownership together. How about we frame it using a SWOT analysis? Strengths, weaknesses, opportunities, threats.
Sounds like a good way to structure it. Let's jump into Chapter 6, Risk Assessment using that SWOT framework.
Okay, start with the strengths. What are Newmont's core advantages?
Number one has to be that unmatched scale and industry-leading reserve base. Over 20 years of visibility is huge.
Right.
Second, that portfolio of Tier 1 assets, primarily in stable jurisdictions, a major de-risking factor. Third, the strong investment-grade balance sheet gives them financial flexibility.
And don't forget the copper.
Absolutely. Significant copper optionality. That gives them valuable exposure to the whole energy transition theme, which is a multi-decade trend. Those are big strengths.
Okay, now for the flip side. What are the weaknesses?
Well, as we've discussed, they are structurally a high-cost producer relative to some key peers. That higher AISC makes them more vulnerable if gold prices fall.
Margin compression risk.
Exactly. Then there's the integration and execution risk tied to that massive Newcrest deal. It's complex. And delivering those synergies isn't guaranteed.
And the insider ownership.
That low insider ownership definitely fits here as a weakness, raising alignment questions. And maybe a subtle one. Some of their recent reserve additions have relied on using higher gold price assumptions in their calculations.
Meaning if the gold price fell significantly.
It could potentially lead to reserve write-downs in the future, a vulnerability there.
Got it. Okay, weaknesses acknowledged. What about opportunities? Where's the upside potential?
The biggest one is simply a sustained bull market in metals. If gold and copper prices stay high or go even higher, driven by macro factors, central banks' energy demand, Newmont's operating leverage means they could generate truly massive free cash flow.
The coiled spring uncoiling upwards.
Precisely. Successfully delivering on those Newcrest synergies is another big opportunity. If they can cut costs and optimize that portfolio, it significantly improves profitability.
Any specific projects?
Yeah, they have a deep pipeline of potential organic growth projects. Things like the Tanami Expansion 2 in Australia, developing the huge Galore Creek copper-gold deposit in Canada with Teck, Norte Abierto in South America. These could add substantial, potentially lower-cost production down the line.
Lots of potential levers to pull there. Finally, the threats. What external factors could derail things?
Commodity price volatility is always threat number one for an unhedged producer like Newmont. A sharp drop in gold or copper prices hits their revenue and cash flow directly and immediately.
The double-edged sword of being unhedged.
Exactly. Geopolitical and regulatory risk is always present, even in Tier 1 countries. Think potential tax hikes, changes to royalty regimes. That can happen anywhere.
Sure.
Macroeconomic headwinds are a threat too. Persistent global inflation could keep pushing up their input costs, pressuring that AISC further. High interest rates could also impact financing costs or broader economic activity.
And anything specific on the horizon?
One potential thing to watch is the impact of possible U.S.-imposed tariffs, maybe coming in 2025, on imported goods. That could affect the cost of mining equipment, materials, adding another layer of cost pressure.
Okay, that SWOT analysis lays out the landscape really clearly. So let's try to synthesize all of this, bring it back to our core question.
Right, let's wrap it up in Chapter 7, Conclusion. Can Newmont turn its huge scale into superior value, especially with rising costs? Or is it getting too big and complex?
What's the final verdict, or at least the different ways to look at it?
Well, let's lay out the bull case first. The bulls see Newmont as the undisputed blue-chip giant in the space. If you want large-scale, liquid exposure to gold and copper, this is your go-to stock.
Highlighting the strengths.
Exactly. Unmatched scale, those industry-leading reserves, the Tier 1 assets, the copper potential, strong balance sheet, aggressive return of capital to shareholders. The core of the bull argument is that immense operating leverage. In a high-price world, it should translate into absolutely massive free cash flow.
Okay, that's the positive spin. What about the bear case?
The bears focus on the costs. They'll say Newmont is not a low-cost producer. That high AISC makes them vulnerable if prices turn down. They'll emphasize the significant integration risk, with Newcrest executing that smoothly and actually getting the promised synergies is a huge if. And they'll definitely point to that extremely low insider ownership and the pattern of stock sales as a major red flag, questioning management's alignment and confidence.
So the bear case says maybe the current valuation already reflects the best case scenario.
Essentially, yes. That there's not much margin for error and the risks are being underestimated.
And our valuation work suggested.
It reflected that complexity. Relative valuation shows it's not the cheapest, gets a premium for assets, but maybe a discount versus cost leaders. Our educational DCF model gave that range of $75 to $90, suggesting some potential upside from the current $69 price.
So putting it all together.
Compared to that intrinsic value range, Newmont looks, reasonably priced, maybe slightly discounted, but it's definitely not a screaming bargain, not a classic deep value cigar butt investment.
Its future performance really hinges on
two absolute key things, I think. First, the external factor. Right. Where do commodity prices go from here? That's largely out of their control. And second, the internal factor. Can management successfully execute this huge post-merger strategic pivot? Can they deliver on the asset sales, the synergies, the cost control?
So highly dependent on both the market and management execution.
That sums it up well. Which leads to a final thought for you, the listener, to mull over. Think about the potential scenarios.
Yeah, okay, lay them out.
Your base case might be metal prices stay pretty high, Newmont manages the asset sales and costs reasonably well, FCF stays strong, and the stock provides modest appreciation from here.
Plausible? What's the upside scenario?
The bull case. Geopolitics gets messier, central banks turn more dovish, driving gold and copper much higher. Newmont knocks it out of the park on synergies and cost control. The result? Explosive free cash flow growth, and the stock surges past that high-end valuation estimate.
And the downside?
The bear case. A global slowdown, or surprisingly hawkish central banks, cause a sharp correction in metal prices. At the same time, cost inflation remains sticky, and they run into operational problems integrating Newcrest. That leads to severe margin compression, FCF collapses like it nearly did in 2023, and the share price takes a significant hit.
Three distinct possibilities for investors to weigh.
Exactly. It really depends on your view of the macro environment and your confidence in management's ability to execute.
Well, that's been a fascinating deep dive into Newmont Corporation. Thank you for walking us through all of that.
My pleasure. Always interesting to dig into the details.
And thank you, our listener, for joining us. Please don't forget to like and subscribe to the 1 Troy Ounce YouTube channel. It helps us keep track of what you find valuable and bring you more analyses like this one.
Absolutely. And just a standard reminder, this analysis was generated by an AI system. It's for educational purposes only. It should definitely not be taken as financial advice.
Always do your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.
That's right.
And finally, this research was produced using an AI system. Thanks again for tuning in to The Deep Dive.